Are you paying for insurance that you didn't even want? That's PMI. There's a way to get rid of it. So let's talk about what it is, why you needed it in the first place, why you may not need it anymore, and exactly how to get rid of it. So, if that sounds good to you and you want to start saving some money, let's get into this. So let's get into the what and why of PMI. So PMI stands for Private Mortgage Insurance. And if you do not put 20% down when you buy your home on a conventional mortgage, they are going to see you as a more risky buyer or borrower, and they're going to require that you pay for this insurance to essentially cover their ass. You are getting nothing out of this. You are paying these premiums, and it is then going from your hands to your lender to the insurance company. So the insurance company is actually covering them, because if you are to default, then the your lender can go back to them and say, "Hey, this homeowner, they defaulted and you need to pay up for the insurance that we've been getting." It's like any other insurance that you get for the insurance company to come out and cover. So if you buy homeowners insurance, you are going to get the company, your insurance company, to pay for something if, say, a tree falls on your roof, right? It's a similar type of thing, except in this case, instead of it being a tree falling, it is you not making your payments to your lender. So while they are getting their ass covered, it is doing absolutely nothing for you. Um, the little bit about the way this is structured. So it could be a fee that is paid upfront at closing. That fee, actually, upfront fee, can be rolled into your loan as well, or it can be broken down into monthly payments, which is typically what happens. And it can vary based on the amount of the mortgage for what you actually have to pay. All right. So let's say you don't have a conventional mortgage and you have an FHA backed mortgage. Well, you're not going to pay PMI. You're actually going to pay something called MIP. So while it's not exactly the same, it's quite similar. MIP is mortgage insurance premium. So it has a very similar function to the PMI because you are insuring them in case of your default. But there are a few differences. So let's go over what those are. So if you have an FHA loan, you can pay the premium as an upfront payment, and that amount would be 1.75% of your loan amount. It can be paid at closing or rolled into the loan overall. Then there is the annual MIP, and this is going to be paid into monthly payments. And this is typically what people do. So the rate for this premium depends on factors like the loan amount, the term, usually, which is 15 or 30 years, and the loan to value ratio. It's typically ranges from 0.45% to 1.05% of the loan balance per year. So there are variables here. The other thing to note with this is that with MIP, if you put less than 10% down, the only way to get out of this is if you actually refi. You have to refi into a conventional loan because it lasts for the life of the loan. Now, if you put over 10% down, you are going to be able to get out of it, but only when you've had the mortgage for 11 years or more. So that is the one caveat here. Even if you put more than 10% down, or if you put 20% down, you're still looking at having a insurance premium on the home for at least 11 years. So those are the main differences. And a lot of people don't think about that because with FHA, they're looking at the low down payment they're actually putting down. So these are things to take into consideration. And even if you have to pay the insurance, really work out the numbers and determine if the monthly payment is going to work better or worse for you than doing that upfront, because the upfront can still be rolled into the loan. So there are things to consider. Hopefully, if you maybe weren't in as good of a financial position when you first got the FHA loan, that later you can refi out into a conventional. Hopefully you have the 20% and then you wouldn't need insurance. Keep in mind, if you refi into a conventional and still don't have 20%, then you're going to have the issue of still having PMI with them. So just refining a loan doesn't get you out of it entirely unless you do have the equity. All right, let's go back to PMI. So let's make a note about what that payment is. It can range from 0.2% to 2% of the loan amount annually, obviously divided into monthly payments, right? Because we're not talking about the upfront fee. Um, so those payments actually they add up to a lot. I've had people tell me that they're anywhere from, $50 a month to $200 a month. So it's a lot of money and people want to know how to get rid of it. So what happens is that technically it automatically falls off when they've reached 22%. Um, I love the automatically because even still, and it's usually like at close to the halfway point of your mortgage loan term is about where it is because obviously loans are front loaded with interest and then you start paying off more of your principal the longer you've had it. Um, but automatic, not always automatic, because a lot of times it's paperwork has to still be done. You still have to sign off on everything. So you need to watch that. Now, if you have gotten to 20% equity, there are a couple ways to do that. You either have to have had market appreciation or you have to have done updates to where your home has reached it. So sometimes it's just the length of time with market appreciation is enough to get people 20% equity. Sometimes people go in and buy a home and then they redo everything and now you've increased, the value of the home. So now you've gotten to the point where you have the equity. But there are a few caveats and they do actually vary from lender to lender. So usually if you are under 2 years since you purchased the home, you are going to have 25% equity and you will have to have done major renovations. We're talking full guts, all the main rooms, the kitchens, the bathrooms, maybe like if a basement gets finished off, any kind of major additions of say a deck outside, large patio, things like landscaping, paint, flooring in and of themselves don't really count unless they're part of a whole project, but you need major things done and they're going to want more equity. I've actually been seeing more and more lenders or hearing from people that they're being told that even if they're in the 2 to 5 year range, that they're needing 25% equity. And this is varying from lender to lender. But typically, if you're in the 2 to 5, you can still get away with 20% equity. And if you're over 5, it's for sure 20%. But again, every lender is different and you just have to check and see what all of your paperwork says, call them, verify. If you're not sure, if the person on the other end wasn't exactly sure, call back, get a different person. Because I also hear from people that sometimes they call in and they are told one thing and then they're told something else. And typically they're going to tell you, yes, this is the number that you would have to reach value wise in order to get rid of it. So don't order and pay for it right away. Just maybe ask if you know any kind of realtors. If you just check on Zillow, I hate Zillow, but if you check there, you're going to get an idea. If you think you're close, go ahead and go forward with it. But keep in mind that you do have to reach these milestones in order to get rid of it. And sometimes people are really close. So some people aren't. So I hate to see you pay for it if you're not there. Most of the time, people have a good idea because a lot of times realtors will send out, hey, this is what this house down the street sold for. And you look at the pictures and you realize it's just like yours and it's similar updates. And you're like, oh, that's probably what my house will go for. Sometimes people have no clue because they're in more of a rural area or their house isn't like everything else. So you actually have to get a professional to determine that. But usually, if you have a good idea that you can get rid of it, if you think you have the value, if you've been there a long time, if you've done a lot of updates, go ahead and go forward. You're going to have to contact them. So let's get into what the next steps are on actually how to get this done. Okay, so next step. If you really think that you have the equity and you want to move forward, the first thing you have to do is contact your lender or loan servicer. You're going to contact them and you're going to say, I want to get rid of my PMI, and either you have the right department or they're going to send you to the right department. They're going to have you fill out paperwork and they're going to have you pay a fee. Now, when you pay the fee, you're probably going to have a couple options. That is not always true of all of the companies. Some of them will say, You're going to have an appraisal because we choose to do appraisals. Some will let you choose an appraisal or a BPO. A BPO is a broker price opinion. So where the appraisal is done by obviously the appraiser, the BPO is done by a real estate professional. Now, in this situation, you are going to get a value, and you're going to get a value by somebody who knows how to value the property. So it really doesn't matter for actually getting this removed. Um, the fact is that if it's an appraisal, they're going to do a little bit more legwork. They have a little bit more stringent guidelines that they have to follow, but they're going to cost you more. And typically, they're somewhere between $300 to $600 for that. The BPO is going to be somewhere between like 150 to 200, and it's still going to give you a value. Sometimes people question it. I get questioned a lot, and I sit there and tell them, I'm like, okay, well, if you're going to list your house, you were going to have a real estate professional come give you a value and tell you what your house could sell for. What's the difference, right? Really, in some ways, we know the market just as well. I tell you what, I value dozens of homes a week. I'm doing a lot. I know the market, right? So I'm sure anybody else who's doing these, they know their market. So you should feel comfortable in going with that option because it's going to save you money and it's still going to give you a good value, right? So if you have the choice, save the money. We're looking to save money anywhere we can, right? So we're going to save money when we choose the BPO, and we're going to save money when we get rid of our PMI. So then we're going to go on to what our next step is going to be. Okay, so let's say you've contacted them. They're going to have paperwork for you. You're going to pay the fee, and then you're going to wait for somebody to contact you. Some lenders and servicers are going to move really fast, and it's going to be absolutely wonderful. I tell everybody, I don't know if everybody has Rocket Mortgage or under the Quicken Loans, if everybody has those, but that company, they are one of the fastest I've ever seen. And not to call anybody out, but Mr. Cooper, as a loan servicer, has been the one I've heard the most complaints about. Unfortunately, with that, once they're sold to the servicers and they're being processed through them, there's not much you can do besides refi to get away from them. And a lot of people are in really low interest rates, so they're not going to do that. But you work with what you have. Just know that some of them you have to stay on more, right? So even getting your first appointment to get somebody out there to do the pictures and the value, you might have to call a couple times. Hopefully not, and that's not always the case. Just know that in this process, you need to stay proactive. So if it moves quick, great. If it doesn't, get on them, right? Then once somebody calls you, they're going to call, they're going to make the appointment. They should not be in your house very long. If you have filled out any paperwork stating any updates, they should have gotten that. Sometimes they don't. So you're going to go over and give them what was updated. Different lenders require different things. Some of them want the dates that stuff was done. Some of them want the cost. Some of them want both. So you're going to want to think about all of that. Be sure that you have some lights on for people so they can take the pictures, and that you don't forget anything that you have done. Even if you don't think it's relevant, tell them. Just let them decide, okay, yeah, I need that or not. Because sometimes people are like, well, I rewired the electrical box. Okay, well, it's not really much of an update, and that's all you did. We're not going to worry about that as much, right? You're going to make a note of it that it was done, but it's not significant to really move your value. If you completely renovated the whole kitchen and moved a wall and rededesigned the entire like main floor or something like that, now we're talking about real value, right? So you tell them everything you've done, and you let them kind of decide which direction it's going for them, and then let them ask you more questions from there. But it's better that you tell them everything and then hold anything back. So when you're talking to them and you have the appointment, just remember your stuff doesn't matter. It doesn't matter what you have out. It doesn't matter, the kids' toys. I have been in a house where there was 3 boys under 10 and there was crayon all over almost every wall. We didn't worry about it. You live in your house and it's your house. It wasn't damaged. It could be washed off. It could be painted over. It wasn't a big deal. It wasn't like doors were hanging off their hinges or anything. So let's just think about getting people out there and not worrying about your stuff. If it's cluttered, if there's rooms that you can't really walk into, it doesn't matter. Okay. Everybody worries about this. I would not want you to hold yourself back from getting your uh, mortgage insurance dropped just because you have stuff in your house. Everybody has stuff in their house. I can't tell you how many garages I go into, and you don't fit cars in there. They're more like storage units. So don't worry about those type of things. Just get this done and over with so you can start saving the money. Couple other things to remember here that I usually tell people: if you haven't heard from your lender in like 2 weeks after I've been out, I always tell people, give them a call. You check on it. Don't just rely on them to get back to you. They might move faster, they might move slower, but sometimes you don't always know where their process is. So just get an idea of that from them. And then the reports in the end come from them. So everything really ends up falling back onto the lender after the report's done. But at that point, hopefully, you've reached the amount of equity that you need so that you can get that PMI removed for conventional mortgages. Again, if it's going to be an MIP, we need to look at where getting our time in or trying to refi out of those, because you're not going to be doing this in the same fashion. The only other thing that you really need to know, and I get asked this a lot, is will my insurance company find out about this or will the city find out about this? So I want to put everybody at ease that this information is not shared beyond the lender. They're not taking the time to go and inform everybody and their brother about your house. Um, the property taxes are assessed on what the city knows, on what permits were pulled, so they know, like how many bathrooms you have or bedrooms or whatever you have done in the home. All of that's going to be assessed from them. So then when it comes to your insurance company, if they ever have any questions, they're not going to your lender. They are either going to look at aerial photos, drive-by pictures, or if they have any questions, they may actually even contact you to come inside. But none of what happens for PMI removal is going to affect anything there. That is a major concern. And again, I don't want people not doing this and not saving money just because they're afraid they're going to lose out somewhere else. This isn't happening like that. So we're going to make sure that we are contacting our lender. If you're unsure if you have the equity, you are going to do a little sleuthing beforehand and see where you are. If you think you can get it, contact them, find out what number you have to hit, and then it kind of gives you some more confirmation. Pay for the report. If you can get the BPO, get the BPO, not the appraisal. Save your money there. And then get somebody out and get the report done so that your lender can get rid of this. It's time that you save a little bit of money on insurance that you don't even want and you don't benefit from. Okay, so till next time, to your financial success.